Selva, shall I start?
Yes, ma'am, you can go ahead.
I can, right? Okay. Okay. Good morning, friends. Welcome to this third meeting on Ind AS on weekends. It's actually very heartening to see so many people who have joined this session today. And even last week, I was talking with the speaker. And it's, very motivating for both the speaker as well as for us, the organizers, that so many of our professional friends do not mind joining with us on a Saturday morning, so early in the morning. So that is our thirst for knowledge and upskilling ourselves. So today we will be actually dealing with the financial instruments. Sir will be dealing with the three standards dealing with accounting for financial instruments. Ind AS 32, Ind AS 107, and Ind AS 109. Ind AS 32, as you all know, will be dealing with the presentation and classification of financial instruments as financial liabilities or equity, and sets out the requirements regarding the offset of the same. That is the financial assets and liabilities in the balance sheet. Ind AS 107, financial instruments disclosures, sets out the disclosures required in respect of the financial instruments. And Ind AS 109, financial instrument, deals with the guidance on the recognition, derecognition, classification, and measurement of financial instruments, including impairment and hedge accounting. I do not want to speak more on these in the standards because I'm not an expert, and I think that Sir will be the right person to deal with it. Before I hand over to Sir, just a small brief profile. CAR Venkatasubramani is the founder of RVS Bell Analytics, a cloud-based software platform providing analytical solutions for accounting as per Ind AS. A graduate of the University of Madras, he is a chartered accountant with over 3 decades of experience, and began his career with a professional accounting firm in Chennai. He is qualified in the year 1983. He is engaged in IFRS and Ind AS advisory services for several clients across the globe, specializing in accounting for financial instruments. He's currently handling several NBFCs in the valuation of expected credit loss, calculation of loan portfolio, and other financial instruments. He was previously working with Calypso Technologies, specializing in hedge accounting as per IFRS 9. And which the company is a leading provider of cross-asset technology solutions for financial markets, with 20 years of experience delivering cross-asset solutions for trading, processing, risk management, and accounting. Calypso is being used by several banks and financial institutions across the globe. And during this tenure, Sir's team was responsible for implementing hedge accounting for several banks situated in Sweden, Australia, New Zealand, and London. And before that, he was head of business management and operations control at North Trust Bangalore. And he was also managing, as a COO, he was managing a team of core finance and accounts professionals in a US-based hedge fund administration firm serving several global clients. He holds a diploma in IFRS from ACCA UK, and he's an All India rank holder in both CA and ICWA exams, and has an overall experience of more than 35 years. He's a teacher, he's a faculty in the ICAI and conducts specialized courses on financial instruments. And he's also authored several books on equities and futures, fixed income securities, then financial instruments as per Ind AS, and 2 other books on the Kindle platform. And I do know that Sir has also developed a lot of softwares and tools, which he generously shares with all the professional colleagues. So very warm welcome to you, Sir. Thank you very much for accepting our invitation. Over to you now.
Thank you. Thanks for your kind introduction. And it's really indeed very heartening to note so many professionals as early as 7:30 in the morning on a Saturday are there to attend the class. I'm really overwhelmed, and it's always a pleasure to be with the SARC class. Okay, so it's special to me. And okay, so today we're going to see the financial instruments. I'll also keep seeing. Okay. So okay. So today, let me share my screen. Okay. Mm, okay. Are you able to see my screen? My Excel sheet.
Yes, sir.
Yeah. Okay. Okay. Now, before we start, I just wanted to give a little bit of an overview about the genesis of the financial accounting standards itself. Okay. So today, as per Ind AS, we have three standards: Ind AS 109, Ind AS 32, and Ind AS 107. Dealing with several aspects of financial instruments. 107 is purely a disclosure standard. Now, the equivalent of this, we had earlier in our IGAP, AS 30, 31, 32. And unfortunately, those were the replica or the cut copy paste of the accounting respective IAS standards that were there in 2008 and 2009. So I'm sorry, AS 30, 31, 32 did not see the light of the day. In fact, it was withdrawn. All the three standards were withdrawn just before, one day before it was supposed to become mandatory. That is on 31st of March 2011, it was withdrawn. So, so to say, we never had any proper accounting standards in the IGAP. So now, as far as Ind AS is concerned, today we have Ind AS 109, which is an exact replica of IFRS 9. IFRS 9 itself is a replaced version of the earlier standard IAS 39. Now, there were several reasons why IFRS 9 itself was promulgated, because IAS 39, in spite of the fact that we all know these IFRS standards are principle-based standards and not rule-based, it was still felt that IAS 39 contained certain rule-based aspects. Those were the ones which were rectified or replaced as per IFRS 9. So we had, in fact, three installments of amendments or modifications that were brought out by IFRS 9. The first one being one in 2009 and 2010 relating to the classification and measurement. And then a major change came about in hedge accounting, which was promulgated in 2013. And finally, the last phase, the impairment portion, which talks about the recent ECL in 2014. So on 24th of July 2014, the final phase of IFRS 9 was promulgated, and then say that's it. So they said that they're going to stop. And at that point of time, the US GAAP, that is a FASB and IASB, decided that they will go on their own path. In fact, they agreed to disagree, especially on the impairment part. So which means this is to give an overview that the impairment provisions as per IFRS 9 is slightly different from the impairment provisions as required under the US GAAP. I mean, we are not going to go deep into it. I just want to give an overview so that you get the 30,000 feet idea about these standards in the right perspective. Now, one of the things that IFRS 9 talks about, and it is also prevalent in throughout the IFRS, is the one which is called as the effective interest rate. So this effective interest rate is something which I believe that you all know pretty well by now. So I'm not going to go deep into this, except to state that, earlier we used to show the difference between the amount that was invested and the amount that is going to be repaid from the company, especially if it is a fixed income security. The difference between these two was treated as a capital gains at the time of the redemption, at the time of when you get the principal back. But now it is no longer so. That difference is supposed to represent interest, and as a result of which you will have to compute the effective interest rate for the entire period. So even though in this example, even though you get an interest income of 6%, which is the coupon rate, your effective interest rate would be something else. Okay, the effective interest rate would be far higher because you bought this at 85 and you're going to get the face value of 100 rupees on maturity date. So the effective interest rate is much higher. So you will have to calculate the difference. It is calculated like this. The effective interest rate, in fact, works out to something like close to 10%. That is the effective rate. Okay, so that is one thing which runs throughout the standard. I just wanted to give this as a sort of a prelude to the whole thing, because everything hinges upon this. Okay, understanding this particular aspect. Now, if you ask me, is this something that is cast in stone? Is the EIR is something that is cast in stone? Yes, it is something that is cast in stone. In other words, once the EIR is determined for a particular investment, it is not changed usually. There is only one exception. There is only one exception, which happens after the discontinuation of a hedge accounting for a fair value hedge covering interest rate risk. Just for you to get an overall understanding, I'm saying that. So just for you to note that this EIR, once it is determined, is never ever changed throughout the life of the financial asset or financial liability, as the case may be. Okay, now let us move on to what is to the standard now. Okay, let us talk about this Ind AS 32. I will probably spending lesser time on Ind AS 32 and spend more time on Ind AS 109. And the reason is because 109 contains the key provisions relating to expected credit loss, which I'm sure many of you would be interested in knowing a lot about expected credit loss, because I'll be dealing with some practical aspects of how to compute the expected credit loss. Okay. Now, Ind AS 32 broadly covers how to identify a financial asset, or how to classify a financial asset, a financial liability, and an equity. That is one of the primary objective of Ind AS 32. The reason why this is so important is that once you treat it as a financial liability, okay, it calls for interest expense, whereas if it is an equity, there is no interest expense. So there's a lot of difference it can make to the accounts when the classification is not correct. Now, what is a financial asset? Now, the financial asset the definition is, it includes cash. So cash is directly mentioned as a financial asset. Then equity instrument of another entity. Then it includes all contractual right to receive cash. So if you have a contractual right to receive cash or other financial assets. So financial asset, so don't get confused, because when we are seeing the definition of financial asset, we are again talking about financial asset, which is equivalent to a circular reference in Excel. So this does not result in circular reference. The standard setters are pretty much aware of this one. So what the interpretation is that ultimately the financial asset should get transformed into either cash or equity instrument of another entity. But so long as it keeps on transforming itself from one financial asset to the other financial asset without being a cash or an equity instrument, is not all right. So eventually it has to transform itself into a cash or another investment in another equity instrument of another entity. So if you have a contractual right to receive cash, then it is a financial asset. Then the next one, to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. Now, this is the one limb of the definition of financial asset that covers the derivative instruments. Now, these derivative instruments, if it is the bought derivative instrument, like the examples of derivative instruments could be the call options, all the options. You also have interest rate derivatives like interest rate swaps or interest rate caps, floors, and so on. Or it could be a cross-currency swap. All these are derivatives. commonly used derivative, FX forwards for that matter, all these are derivatives. Now, so long as you have a bought derivative, if it is a option-based derivative, there are two types. It could either be options or it could be futures. But if it is an option-based derivative, so long as you have bought a contract, it will be an asset all the time. So normally what happens is that it becomes an expense till the time of the expiry date. On the expiry date, whether it is in the money. If it is in the money, then it becomes an asset. If it is out of the money, then it becomes an expense and it is written off. So as far as a derivative instrument, if it is a bought derivative instrument, then it can only be a financial asset. It can never be a financial liability. At the most, it can be an expense which will be written off. Now, the next part looks like a little complicated, complex. I will read it for whatever it is worth, but then I will explain this with an example so that you can understand better. A contract that will or may be settled in the entity's own equity instrument and is a non-derivative, resulting in receiving a variable number of the entity's own equity instruments. If it is a derivative that will be settled other than by the exchange of a fixed amount of cash or other financial asset for a fixed number. Now that is just a definition, but let us see a practical example of how this translates into. Now let us take two cases. Okay, one case where you have a receivable of 5 lakhs. Okay, you have a receivable. That means you have a contractual right to receive cash. You have the contractual right to receive 5 lakhs cash. Now, if this is going to be settled in cash, obviously it is a financial asset. There is no question about it. So it is a financial asset all the time. But in case it is going to be settled by the entity's own equity instrument, that means you are going to get paid for this 5 lakhs by your own equity instrument, then let us examine, let us think about a particular situation where the current rate per share is 100 rupees. So it translates to 5,000 shares. So you are entitled to 5,000 shares. Then the value obtained becomes 5 lakhs. Now you have two choices to make. One is either you keep this 5,000 fixed, okay, or you keep this 5 lakhs fixed. Which one you want to keep it fixed? Now, if you keep this 5 lakhs as fixed, then at the time of settlement, let us think about a scenario 1 where the rate per share becomes 125. Then you will be entitled to receive only 4,000 shares of your own shares. But the amount that you will be receiving will be 5 lakhs. On the other hand, if the rate per share, your own share, goes down from 100 rupees to 80 rupees, then you will be entitled to a more number of shares, which is 6,250 shares, but the value obtained will be 5 lakhs. So if the value to be obtained, this is the value to be obtained is 5 lakhs all the time, then it is a financial asset. That means you are not taking the risk and the reward of this financial instrument. The risk and the reward is not with you. It is with whom? It is with the counterparty. It is with the other person. So you don't take any risk. Whatever may be the value, you will always get so many number of shares that will be equal to the 5 lakhs, which is what you have to receive. You have a contractual right to receive. On the other hand, let us assume a situation where you are saying, okay, I will take 5,000 shares because today the rate is 100. So today my value is 5 lakhs. Okay, I'm happy with it. But if my own shares, the value of my own shares goes up, then I will actually be getting more value. On the other hand, if my own shares goes down, I'll be getting less value. That means you are basically trying to get the risk and the reward of this transaction. So the counterparty has effectively transferred the risk and the reward of this deal to you, in which case this becomes an investment in equity. It is an equity. You are investing in your own equity shares. It is like equity. So this has to be reduced from your equity. On the in the first case, this is fixed. Okay, 5 lakhs is fixed, but the number of shares is variable. Here it is variable. So if it is variable, then it is a financial asset. If this is fixed, then it is equity. So now the rule is, if it is fixed for fixed, then it is equity. If it is variable for either fixed or variable, it could be also variable, right? It could. So long as any of these things are variable, then it becomes a financial asset. So let me repeat once again. If this is fixed, if the number of shares is fixed, then it becomes an equity. If the number of shares are variable, or if the value to be obtained is also variable, then it becomes a financial asset. So that is basically the difference. Now, I hope it is clear. Now let us move on. Okay, we have quite a lot to cover. So I don't want to rush. Definitely, I don't want to rush. But whatever I am covering, I want to do it in depth so that we understand. Okay. Now, anyway, see, after some of the slides I may not be explaining. I will just go on, because it doesn't call for an explanation, because you are going to get the entire deck after the class. So it will be with you. Now, these are some of examples of financial instruments and non-financial instruments. Okay. Now, the contract, just understand this one, the contract to deal with a non-financial asset. A contract to deal with a non-financial asset is not a financial instrument. Please note, a contract to deal with a non-financial asset is not a financial instrument. But there are some exceptions. The exception also tells you that if this contract to buy or sell a non-financial asset, if it can be settled either net in cash or by exchanging financial instrument, or it is readily convertible to cash, then it will be treated as though it is a financial instrument. That means all the provisions that are applicable to a financial instruments will be applicable to this. But in spite of the fact that it is applicable, it is not a financial instrument. That's what I want you to understand. Okay. Now, the financial liability, I think we need not go very deep into it, because it is exactly the other side of the same coin, which is financial asset, except that there we had a contractual right to receive cash. Here, there is a contractual obligation to deliver cash. It is the other side of the same coin. So there it was contractual right. Here it is a contractual obligation. So again, this second limb of the first part talks about the derivative instruments. So if the derivative instruments is written means sold. It is a sold option, then it is a liability. It always remains a liability. Sometimes it can become an income, which will be known only on the settlement date. So it can either, if it expires out of the money, then it becomes an income. Otherwise, it is a liability only. So always it will be shown as a liability. Now, the second part, of course, is the same as what we already saw. So here, the condition is if the fixed to fixed is satisfied, then it becomes an equity. If it is not satisfied, if there is a variable element, then it becomes a financial liability. So exactly the same as what we saw there. Now, obligation to deliver cash. So examples of contractual obligation to deliver cash, redeemable shares. So these redeemable shares, you have to part with the money. That means you have to pay the money. So this has to be treated only as a liability. The mandatory dividends, distribution of specified percentage of profits, are not at the discretion of the issuer's discretion, where the terms and conditions of the instrument contain a formula under which a specified percentage of profit must be paid. So all these are examples where you have an obligation to deliver cash. So long as you have an obligation to deliver cash, then it becomes a financial liability only. It cannot become an equity. That's one of the primary characteristics. Now, I think I explained this to you already. Potentially unfavorable. What do you mean by potentially unfavorable? Potentially unfavorable means it is a written option, or it is an option that is sold. So if you have an option that is sold, you have a potentially unfavorable situation. That means it can go against you. So it will always be shown as a liability. So this derivative contract will always be shown as a liability. So written examples are written call options and written put options. So both these are liabilities only. So it always remains a liability till the date of expiry, when it may become an income. Okay, so it is the same. Then you have the equity instrument. The third category is the equity instrument. So whichever is not a financial liability is of course an equity instrument. Here, the key element, as I said, is a contract that evidences a residual interest in the net asset of the entity. So that means you are taking on the risk and the reward. So if you are taking the risk and the reward, then it becomes an equity instrument. If the risk and the reward is not with you, it is with the counterparty, that it is either a financial asset. If it is receivable, it is a financial liability. It is payable if it is payable. If there is a contractual obligation to pay, then it becomes a financial liability. It is a contractual right to receive, it becomes a financial asset. Now, some examples of equity instruments are equity shares, preference shares under certain conditions, warrants, written call options to issue fixed number of equity shares for a fixed price. All these are some examples. Okay. So equity instrument, the first and primary condition is that there should be no contractual obligation to deliver cash. So in the case of equity, in the case of financial liability, there is a contractual obligation to pay cash, to deliver cash. In the case of equity, there is no contractual obligation to deliver cash. That is the primary difference. Then the second one is, the second important condition is that the exchange ratio is fixed for fixed. If it is a fixed for fixed, then it means that you are basically having the risk and the reward of such instruments. So you have ultimately what is known as the evidences. It becomes a contract that evidences a residual interest, then it becomes an equity. As far as you are concerned, you have to treat it as an equity. Okay. So I think I have explained all this. So I need not once again explain. I have explained this. Okay, there's a beautiful example that is given in the standard. Okay, it says that let us look at a contract to deliver as many of the entity's own equity instrument as are equal in value to rupees 1,000. So you don't know how many number of shares, right? So it becomes it is a liability. Then the second example that is given is a contract to deliver as many of the entity's own equity instrument as are equal in value to the value of 1 kilo. So first thing, you don't know what is the value, what is going to be the value of 1 kilogram of gold. You also don't know what is going to be the value of your own equity instrument. So obviously it is a variable to a variable. Both are variable. If both are variable, it can't be an equity. It has got to be a liability. So such contract does not evidence a residual interest in the entity's assets. So that means it becomes either a financial liability or a financial asset, depending upon whether you have to receive or to pay. Again, there are some examples. So the classification of between liability and equity is not dependent on some of these things, like history of making distributions, intention to make distribution in the future, possible negative impact on the price, blah blah blah. So many examples are given there. So all these are not going to decide. So what is going to decide is only the first two conditions, that whether there is a contractual right or whether you have to have what is called as the right fixed to fixed or fixed variable to fixed. So these are the only things. Okay. Now there is one example. We'll see just one example and then we will move on. Actually, I want to I want to complete IS 32 by 8:15, and probably if we have time, we will come back because okay. Now, R Limited purchases a call option from Z Limited on 1,000 of our shares with a strike price of 103 per share, premium of ₹6. The call option expires in 6 months' time. The current share price is ₹100. The price of our shares shot up to 110. So how is the transaction accounted? Now, this is a settlement with the own equity instrument, with the entity's own equity instrument. Now, the settlement is through the entity's own equity instrument. The contract is a derivative contract. The contract will be settled by exchanging a fixed number. Why? Because it is going to be exchanged only 1,000 numbers. It's going to be exchanged. This satisfies all the conditions of an equity instrument. So the fixed sum, why it is fixed? Because you have already paid the premium for this. So that means the strike price is already known. This is the strike price. So it is fixed. The number of shares is 1,000. That is also fixed. So both are fixed. So it becomes equity. So the condition is satisfied. It becomes an equity. So whatever premium that you pay will also be adjusted towards the equity. Now, R Limited should debit the cost of the premium to equity. So because this is a transaction that has to be recorded as an equity, the option premium what you pay will be treated as part of the equity. Now, the important point for you to understand is that this entry will never be reversed even if the contract is not exercised. Even if you do not exercise this contract, even then whatever goes to equity will remain there in equity. This will never be reversed. Okay. Now, when R exercises the option, now will R exercise the option? Yes, R will exercise the option. The reason is because the strike price is 103 and the market rate at the time when the contract expires is 110, which means the contract is in the money. The contract is in the money. Obviously, this R will exercise the option. So Z would deliver 1,000 of R shares for 103 rupees only. So it will so equity will be debited with 103 and R will pay 103,000. Okay, the price of R shares being 110 at the time of exercise the option has no relevance for this entry, except to the extent of the fact that R will be exercising the option because it is in the money. Okay. So then one more example we'll see. Now, a company issues a debt for rupees 10 lakhs. The debt will be repaid using its equity shares to the value of 10 lakhs. That means whatever may be the value of the equity shares, the amount that will be settled will always be 10 lakhs. So that means this is the nature of liability. In spite of the fact that this liability is settled with its own equity instrument, it will still be treated as liability because the number of shares becomes variable here. So the total number of shares required to settle will vary depending upon the price of its own shares. So that means the risk and the reward is already parted. So you don't have the risk and the reward. You have to only pay 10 lakhs, whatever may be the price of your shares. So the price goes up, then you will probably be delivering lesser number of your own shares. Okay, so I think we will. I will leave this at that because we have covered the essence of this one. We will come back if time permits. We will come back to cover some more aspect of this. So we will move on to, because there are some aspects of 109 which will have a bearing on this as well. So I will move on to 109. Right? I think I have some questions. Oh, okay. Sorry, I have. Will this transaction amount to buyback? Yes, it amounts to buyback of shares. Yes. Full screen mode. Okay. 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 Fine. Now I will just go through one portion where there is a compound instrument. So we will see this one. Now, there are certain instruments which have both. Oh, I have to go to the full screen mode. Sorry. Yeah, is it clear now? Okay. So the compound instruments have both a liability and equity element. Now here there is a little bit of explanation is required here. Now the component parts should be separated from each other. Each part is accounted for and presented separately. Now typical examples are this convertible debentures or convertible bonds. Okay, so the convertible bonds can be converted into equity shares. Now there are two types of conversion that can happen. One is optionally convertible, the other is compulsorily convertible. Okay. Now there is a subtle difference between the two. If it is optionally convertible, then you will have to find out. Okay, first thing, how do you separate these two parts? How do you segregate the equity part with the liability part? Now there is an obligation to pay the principal. Okay, there is an obligation to pay the principal and interest. So that is the financial liability. Now the obligation to pay the principal is there because it is optionally convertible. If it is compulsorily convertible, there will not be any obligation to pay the principal. So it has to be compulsorily, it would be compulsorily converted. But if it is optionally convertible, then there is an obligation to pay the principal. Of course, there is an obligation to pay the interest in all cases. Okay. Now the other is the equity instrument. The equity instrument is the other is the equity instrument, which is a call option, which is written to the holder to convert the debt security into common shares. So some portion of this can be converted. The separation of the components is made at the time the instrument is issued, and it is not revised subsequently. So you will have to do the separation. You have to find out what is the equity component, what is the liability component. And once it is separated, once the components are identified, it is again not revisited, in spite of the fact that some of the terms and conditions, some of the conditions may be changed. Like for example, now let us take a case where an entity issues 2,000 convertible debentures. The face value is 1,000 per debenture, giving a total proceeds of 20 lakhs. So the total liability at this time, it is a liability because it is a debenture, but because it is convertible, there is also some equity element in that. Now interest is payable annually in arrears at 7%. Each debenture is convertible at any time up to maturity. That means it is optionally convertible. Somebody who doesn't want to convert can jolly well wait till the maturity and collect cash in full. So when the debentures are issued, the risk-free rate of return, the risk-free interest rate was 7.5%. The credit spread of the company based on B rating was 250 basis points for a 3-year term. That means you have to basically compare a similar instrument which does not contain the convertible option, the convertible feature. So a similar instrument which does not have a convertible option is available for 7.5 plus 250, which is 10, which is called as 10%, right? So 7.5% plus 250 basis points is 10%. So you have to find out the difference between 10% and 7%. So 3% is actually the premium which you are foregoing in order to collect the equity shares of the company. So 3% is the one which you are willing to sacrifice in order to collect some shares of this company. So you have to first compute the liability. Now the liability component is measured first. So what is the liability component? What are the liabilities? The liabilities are first is the interest payments that you have to make every year. The second one is the principal which you have to pay at the end of the period. So these are the two things. So you will have to use the discounting rate of 10% because an instrument without the conversion feature is available in the market for at 10%. 7.5% is the risk-free rate. 2.5% is the credit spread. So 10% is the market rate for a similar instrument which does not have a conversion feature. So you have to basically discount these cash flows at the rate of 10%. So if you discount it at 10%, now the principal components are discounted, interest components is also discounted. Finally, you find that the present value of the debt component becomes 18,50,000. The total sale proceeds, the issue proceeds is 20 lakhs. So the difference of 1,49,000 represents the equity component. Now, there are two things here. One is, once this is segregated, you will not be revisiting this. In other words, this will remain as it is. That is number one, point number one. Point number two, the debt component is now 18,50,789, which will be valued at, which will be classified as amortized cost. So the classification of this debt will be at amortized cost, which means 18,50,789, you will have to repay 20 lakhs at the end of 3 years. So that means there will be an interest element that will be added. Now, so 18,50,000 is the opening liability. You have to add interest at the based on the effective interest rate, which I said in the beginning of this session. So add that interest and your closing liability becomes this. So the closing liability at the end of the 3-year period will be 20 lakhs, which will be sufficient for you to pay off if nobody converts it, right? So this is an additional entry that you'll have to pass. There is an interest component on the liability also has to be computed. Okay. Now I think these are the two things which I wanted to cover. Now what we will do is let us go on to the 109. Okay, and yeah, some chat message. Okay. Now let us move on to 109. Okay. Now this 109, we will. Yeah. Now 109, we are starting off with the same slide. Okay, I have already explained this. I'm not going to do the explanation once again. So here it talks about the financial assets. Now let us focus on the financial assets. Now what we're going to see is about the classification of financial assets. How are we going to classify the financial asset? The classification becomes very important because the accounting entries that would be passed for each one of this would be different if the classification is different. So classification becomes very, very important. Now, I said at the beginning of the session, the IFRS 9 replaced IAS 39 because IAS 39, it was felt, was truly not principle based. It was at some places rule based. So they wanted to rectify that and then make IAS 39 also completely principle based, and those principles were enunciated, were incorporated in IFRS 9. Okay. Fortunately for us in India, we never had to go through the trouble of learning IAS 39 and then unlearning IAS 39. Okay. So we directly learned Ind AS 109, fortunately, which is an exact replica of IFRS 9. So the principle based things that were carried out here is in relation to the two things. One is the classification, the other one is on account of the hedge accounting. And of course, you can say to some extent that the third one is relating to the expected credit loss. So for all these three, a lot of principles are enunciated in IFRS 9, which we have taken it as it is in Ind AS 109. That's what I'm going to explain today. These are very, very interesting concepts. I'll tell you some of these concepts. It will okay. If the OCD, if the optionally convertible debentures is settled in cash, what is the treatment of equity component? Will it remain there forever? Yes, it will remain in equity forever. That is not going to impact, even if it is settled in cash. Whatever is taken to equity will remain in equity. It is not going to be affected by the conversion, conversion option being exercised or not. It doesn't matter. It is treated as equity. It is treated as equity. It remains there forever. Okay, yeah. So please feel free to ask your questions in the box, and I will definitely answer as soon as I can. Okay, now let us look at this classification. Now, classification broadly, we have these four types of financial assets. Okay, cash, equity instruments. We saw these two as part of financial assets in the definition. So there is no need for any explanation for this because these are defined as it is in the definition of financial assets. Cash, equity instruments. That is equity instruments of another entity. Then you have a contractual right to receive cash, which you can call it as a debt instrument. The contractual right to receive cash is a debt instrument. Okay, so I mean we are not talking about the receivables here. So we are talking about the long term. Okay, even though receivables also will come under this. Then you have derivative instruments, which is covered in a separate limb of the definition of financial assets, derivative instruments. Now let us cover the first and the last, which is cash. Cash is always at amortized cost. That means so long as we are not in a hyperinflationary economy, the cash will always be recorded, will always be treated as or classified as amortized cost. Okay. Then the derivative instruments will always be treated, will always be recorded or classified as FVTPL. That means the fair value changes of the derivative instruments will always be taken to the profit and loss account. The fair value changes are recorded through profit and loss account. That is why we call it as FVTPL, fair value through P&L, derivative instruments. So it is very simple. Derivative instruments, FVTPL. Now the complication arises only for these two, equity instruments and debt instruments. So we are left with two, which is in between. Okay, the two extremes, very easy. In between equity and debt. That's what we're going to see now. If it is an equity instrument, then the classification is either FVTPL or FVOCI. Because there is no third classification called amortized cost, because you are not going to get this back from the entity. That means whatever you have invested in a company in the form of an equity instrument, you can realize that only by selling it to someone else. You won't be getting that instrument. You won't be getting the money back or the cash flows back from the company, except in one case, which is the liquidation of the company. Upon liquidation, of course, you will get, right? So otherwise, as a normal going concern, you are not going to get that. That is number one. So if it is an equity instrument, we have only two classifications, namely FVTPL and FVOCI. If it is a debt instrument, the primary category is amortized cost, where you will get the money back from the company and you have an intention and ability to hold it till maturity. So does it sound a bell in you when I say you have the intention and the ability to hold it till maturity? This was the way it was defined earlier in IAS 39. So previously the definition used to be called as HTM category or called as held to maturity category, which means it says that you should have the intention to hold till maturity and ability to hold till maturity. Both this intention and ability are completely subjective terms. These are not objective terms. These are subjective terms. That means what is intention and what is ability? Nobody can define that. Nobody can find out the intention, right? So that is the reason why we have now moved away from this definition of having any reference to intention or ability. Instead, there are some objective criteria that are enforced today to find out how the classification should be made. And that is why I said now this has become all the more principle based, and there is no question of any subjective elements here altogether. Then, of course, you have the FETPL and FEOCI. As a corollary to this, we will see how this classification is determined. Some chat. Okay, see, in transaction cost, what exactly, please explain how to determine whether a particular transaction goes to FETP. Yeah, of course, I'm going to explain the first one. Amit Kumar, I'm going to explain the first one. Please explain how to determine whether a particular transaction goes to FETPL or FEOC. Of course, we are going to see that. That is the main part of our discussion today. Then in transaction cost, what exactly directly attributable means, to give some examples. Whether consultants expenses paid for acquisition of investment 100% wholly owned. Okay, see, my suggestion is, I'm not going to go into specific instances or specific cases because we won't have time to deal with it. My request to you is that if it is a particular situation based question, it's not a generic principle based question, but if it is a particular specific issue based question, please send it to me by email and I will answer it to you. Okay, because it may not be relevant to many of the other people, but I will definitely answer it to you. But if it is an overall principle based question about this, conceptual based question, I will explain here. Okay, the reason is also because we don't have the luxury of having 3 days. Normally this topic I teach over a period of 3 full days, 9 to 5, but we are trying to cover that in 2 hours. Okay, so we are under time constraint as well. But at the same time, I don't want to sacrifice on the quality on whatever we do here. Now, the financial literacy, the classification criteria. I said it is completely objective based classification criteria. Let us see how it is defined. Okay, the first one is the asset and equity investment. So the first thing, is it an equity or debt? Now these are the only 2 things we are going to see now. Okay, the first one, if it is an equity, if it is an equity investment, then is it held for trading purposes? If it is held for trading purpose, if it is not held for trading purposes, then the entity has the choice to exercise whether it want to treat this or classify this as OCI. That means other comprehensive income, whether it wants to classify this as OCI. So if the option is exercised, the option or the choice, so sometimes I deliberately refrain from using the word option because you start to confuse this with call option, put option. So that's why I say choice. So if the choice is not exercised, if the choice is exercised, then it will be classified as FVOCI. Then if it is held for trading purposes, no questions asked, straight away it will be classified as FVTPL, that is fair value through P&L. Now let us examine this a little further. Now the first thing is, when should the choice be exercised? Now there are 2 things. One is the choice is irrevocable. The second one is the choice has to be exercised by the entity without undue delay. That means the entity can't say, today I will invest in equity shares, and at the end of the year, depending upon the price of the share, I will decide whether I want to treat it as FETPL or FEOCI. No, that's not possible. You have to specify without undue delay. So you are buying at 10 o'clock. So it doesn't mean that 10:01 you should classify. That is also not required. You have to do it without undue delay. Okay, so obviously it should be done without much delay. The second one is, once you exercise the option of classifying it as FPOCI, then it becomes irrevocable. You can't say at the end of the year or sometime later, you can't say, no, 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 I want to classify this as FETPL. That is not possible. Now, the third important point is that this can be exercised on an instrument by instrument basis. So this can be exercised on an instrument by instrument basis. Okay, now see, my request to some of you who is that please switch off the video if you're not if you're not sitting on the desk. Okay, if you're sitting on the desk, please switch on the video, because I will definitely like to see someone and talk. You know, it's always better to see instead of talking to my own screen. But if you're not on the desk, please switch off the video. Okay. The yeah, thank you. I mean, I would request as many of you who are sitting on the desk to switch on their video so that I can see some live people. It'll definitely motivate me. Thanks. Who is this? Yeah. Oh, very kind of you. Nice of you to have switched on the video. Okay. It really makes a lot of difference. You know, I feel like talking to some people like you know in the class. So we are all used to taking sessions for the last several years. We are getting used to online also. That's a different matter. Okay, now this can be exercised on a case, on an instrument by instrument basis. Okay, that is one. Now, so these are the three important aspects. Now let us move on to debt security. So for a debt security, the first question is asked is that, are the assets contractual cash flows represent solely payment of principal and interest? So this SPPI test is the first one. That is, it is a test that has to be applied on the instrument level, at the instrument level first. That means if the test passes, then the test would pass for you, for me, for everyone. If somebody were to invest in a particular debt security, say for example, let us take the case, you know, debentures issued by Tata Motors. Okay, debentures of Tata Motors. Debentures of Tata Motors may pass this SPPI test. So if you invest in Tata Motors debentures or I invest in Tata Motors debentures, it is still going to pass because the test is applied at the instrument level. So what are the characteristics? The thing is, you have to dissect the contractual cash flows. The contractual cash flows, does it represent solely payment of principal and interest? So if it represents solely payment of principal and interest, then the SPPI test is passed. So now this comes to the interesting question: what is principal? What is interest? Okay. Now principal is very clear. Principal is the money that is paid, so you'll have to get it back. But as far as interest is concerned, interest is defined as the time value of money. Interest is the time value of money. Okay, that is the general thing. But it also represents certain other things. Interest also means something else, which means it can also be towards the compensation for the liquidity risk or credit risk and so on. It also includes some profit element, some profit margin is also there. Okay, so apart from all these things, so whether it conforms to all of those things, then it becomes the SPPI test is satisfied. Now, if the SPPI test is satisfied, or if it passes the SPPI test, then it becomes eligible for being treated, for being classified as amortized cost. It doesn't ipso facto become amortized cost, it becomes eligible. Now, the second test which you have to apply, okay, if the test fails, first itself the SPPI test fails, then it will be treated as, it should be classified as FETPL. So there is no need for going to the second test. So if the first test passes, then the second one is you find out what is the business model objective. What is the business model objective behind holding this particular investment? Is it to collect contractual cash flows only? If it is to collect contractual cash flows only, then it will be treated as amortized cost. It will be classified as amortized cost. If it is going to be, if it is no, then the second question is the business model objective to hold, to collect contractual cash flows and also to sell? And also to sell means you can sell once, only once. You can't keep buying and selling. Then it becomes trading. So if it is to collect the contractual cash flows and also to sell when the time requirement, at the appropriate time, at the opportune time, it also enables you to sell, then it will be classified as FVOCI debt instruments. Okay. So now if the business model objective is to collect only contractual cash flows, then it will be treated as it will be treated as amortized cost. Okay. Now I hope this is clear. Now let me explain this to you once again. If it is not an equity instrument, it is a debt instrument. If it is a debt instrument, there are two tests that are applied. The first test is SPPI test. SPPI test is applied on the instrument. So it is not applied on the entity which holds that instrument. It is applied on the instrument. So the test is whether the contractual cash flows represent solely payment of principal and interest. If it represents solely payment of principal and interest, then it becomes eligible for the next question. The next question is, what is the business model objective? If the business model objective to collect contractual cash flows only, if the answer is yes, then it will be classified as amortized cost. If the answer is no, then you find out, are you going to sell this only once? Okay. If it is only once, fine, it will be treated as FVOCI. But on the other hand, if you say that, no, I will keep buying and selling, which is the last one, I'll keep buying and selling, then it becomes FVTPL. The answer is no, then it becomes FVTPL. Now, if you examine carefully, I have taken one more classification called FVOCI for debt instruments and FVOCI for equity instrument. There is a subtle difference between the two. Now, the difference is in the case of in the case of FVOCI equity instruments, it is by exercising the choice. The entity exercises the choice, as a result of which you end up classifying an equity instrument as FVOCI. FVTPL, it is a residual. Okay, if it is not FVOCI, then it becomes FVTPL. Okay, FVOCI debt instrument is by applying a set of objective criteria. You apply a set of objective criteria. The entity has no choice. You don't have a choice to say, okay, I want to classify this as FVOCI for a debt instrument. No, it is by applying a set of objective criteria. Finally, amortized cost is also by applying a set of objective criteria. Now, this amortized cost is also known as a very, very coveted class. Everybody wants to classify their investments as amortized cost. The reason being, if you classify this as an amortized cost, then there is no question of any fluctuations in your P&L, because you are not bothered about the fair value of the instrument, because the fair value changes of amortized cost instruments are not recognized in the P&L. So you don't worry about the fair value changes. Whereas if it is an FVOCI debt instrument, you are it is going to affect your P&L, because it will be the fair value changes are recorded not in the P&L in the case of debt instrument, in OCI. Okay. Now, is this conceptually clear to you? If you have any doubt, please ask. I will explain this, because according to me, the most important aspect of the 109 is the classification, because the classification tells you everything. Okay, I think there are some questions. Let me go through. Intention to ascertain the business model objective. No, there is no intention here. Okay, the business model is what is defined in the board resolution. Okay, it is the business model objective is documented, defined and documented. It is not equal to intention. It does not amount to intention used in the previous standard. Okay. Interest, effective interest rate. Okay, no, don't confuse this interest with effective interest rate. Okay, effective interest rate is the one that is computed based on certain criteria. So there are certain transaction costs that are allowed, certain transaction costs that are not allowed, and based on that you arrive at the effective interest rate based on whatever coupons you pay, etc. Now here what we are talking about is, does the contractual cash flows represent interest? Now let me give an example to make this point clear to you. If there is an instrument, let us assume there is an instrument. Okay, the instrument pays interest at the rate of 10% if the Nifty stays below 15,000. If the Nifty stays below 15,000, interest is paid at the rate of 10%. If the Nifty goes above 15,000, interest is paid at the rate of 12%. Okay. Now, in this case, the interest what is reckoned is does not represent the time value of money. Okay, even though the interest quantum is defined with reference to the percentage 10 and 12, the interest as an expense itself does not represent the time value of money. It's not purely a time value of money, because it depends upon the performance of something which is not in the control. It is performance of an equity index like Nifty, right? Or it can be like this. You'll charge interest at the rate of 10% if my sales is above sales is less than 100 crores. If my sales exceeds 100 crores, then you'll charge interest at the rate of 12%. Again, it is not a time. Interest doesn't represent the time value of money here. So that is the explanation for that. Okay, Amit Kumar couldn't get FETPL and FEOCI. Okay, Amit, you still have doubt, or you want me to explain the concept of FEOCI and FETPL? See, FETPL is the residual class. That means if it is in the case of equity instruments, if you do not exercise the choice of classifying it as FEOCI, it becomes FETPL. Now, in the case of debt instrument, if the SPPI test fails, then it will be classified as FETPL. The second one, if the business model objective is to keep buying and selling, if it is for trading purposes, then it becomes FETPL. Or if the business model is not to collect only contractual cash flows, or if the business model is not even to sell once, that means to keep buying and selling, it becomes obviously trading, then it will be treated as FETPL. Okay. Now, I'm going to ask you one question, and probably at that time, okay. Now, based on this, I'm going to give you one. Okay. Now this let me skip this. I think this we have covered this. So for amortized cost, business model is to collect contractual cash flows only. Contractual cash flows representing principal and interest. SPPI criteria should be met. Solely payment of principal and interest. Okay. Now I think we will skip that. Now let us come to this interest part. Okay. Let me explain this. Interest is the consideration for time value of money. I have two more questions. Let me see. Example, product interest rate being variable based on the performance. Is this a contingent liability? No. This is not a contingent liability at all. This is the way interest is reckoned. Okay. Now the interest is reckoned usually with reference to some. It can be with reference to a benchmark. Like for example, it could be based on LIBOR, MIBOR, etc. Okay. Then in that case, it is perfectly treated as interest only. It has the quality of an interest. But if it is outside of this, like for example, it is based on the performance of an equity index, it's based on the performance of the company, of the profitability of the company, then it loses the characteristics of being an interest. Okay. Now, let me, okay. Now let me tell you what is interest. Now, interest, there are four components of interest. Okay. One is predominantly it is the time value of money. The second one is credit risk associated with the principal amount outstanding during a particular period of time. Interest also includes consideration for the basic lending risk, that is the liquidity risk and administrative cost, and finally it includes a profit margin. So these are the four key components of interest. Okay, so long as these four key components are present, then it has the characteristics of interest. But if it is not, then it will not be treated as an interest. It will not be treated as interest, or in other words, it will fail the SPPI test. Okay, same thing. Okay, now the business model. Let me explain the business model a little bit more. This is not dependent on the management's intention and ability, which is how it was defined previously. There is no reference to management intention and ability. It is not instrument by instrument. It is assessed at a higher level of aggregation. It is not at the entity level. That means it is not at the entity level, at the highest level of aggregation. No, it is applied at the portfolio level or a sub-portfolio level, which means you can have more than one business model for managing financial assets. You can have more than one business. That means you can have one portfolio which can be classified as amortized cost, one portfolio which can be classified as FVOCI, another as FVTPL. So this is a matter of fact, and it is typically observable. Okay. Now the classification: FVOCI, equity instruments, dividends recognized in P&L, changes recognized of the fair value changes recognized in OCI. There is no reclassification of gains or losses to P&L on derecognition. Okay. Now, I'm going to ask this as a question to you. Just 1 minute. Let us go through this slide, and then I will ask you the question. FVOCI debt instrument, interest revenue, credit impairment, etc. All these are recognized in the P&L. Gains, other gains and losses recognized in OCI. On derecognition, cumulative gains and losses is reclassified to P&L. Cumulative gains or losses is reclassified to P&L. Now, amortized costs, there is no question of only the interest is accounted for, but there is no question of changes in the fair value. Okay. Now, this is the question that I'm going to ask you. Okay. Now, the equity instrument and debt security, we are going to see the. Okay. Now, what I'm going to, we are seeing the classification as FVOCI. Okay, equity instrument and debt security. I'm taking one example where initially you purchased an equity instrument for 100 rupees. The fair value at the end of the year, year one is 115. So the 15 rupees is taken to the other comprehensive income. At the end of second year, it is 125. The additional or incremental 15 rupees is taken to OCI. The third year, it is liquidated at 130. So the incremental 5 rupees is taken to OCI. Now that is the same both for equity instrument as well as for debt security. But for debt security, you pass an additional entry where the entire 30 rupees which is lying in OCI is now recognized in P&L, which is not the case in equity instrument. Now, I want you to type, at least a few of you to type out, what is the reason for this differential treatment? If you have understood the classification completely, then you should be able to answer this question. The classification criteria is, if it is understood, then you'll, I'm not going to spend much time. We don't have much time. I will probably give 2 minutes for you to type out. And based on that, I'm going to give you the answer. if I hope you understood the question. The question is, why is the cumulative gains in the other comprehensive income is transferred to P&L when the asset is liquidated in the case of a debt security and not so in the case of equity instrument? That is a question. Yes, please, some more answers. Debt instrument, FUOCI debt is not residual interest. Okay. Okay. Amit Kumar. Debt is based on amortized cost, where the moment is not recognized at all, but in equity, it will remain in OCI only since the intention was to recognize the fluctuation. Okay. Okay. Any other answer? I'll wait for 3 more answers. Equity instrument has ownership rights. Okay. Any other answer? Equity is transferable while debt can only be redeemed. Why? Debt can also be transferred. No, it can also be sold. If it is listed, it can also be sold, right? It can be sold. But equity ownership interest cannot be transferred to P&L. Ownership interest. What do you mean? I don't understand that. Because we are talking about investment in equity shares, right? So it is not our equity. It is an investment in the equity shares of some other company. Equity instrument of some other company. It's an investment. It is not your equity. Equity is not realized while debt is realized. Okay. Okay. I don't think we are anywhere close. I am just one answer which is somewhat closer. Realized. Okay. I will ask you one question. Then let me rephrase it. Okay. What is the motivating factor to classify an equity instrument as FEOCI instead of FETPL? Why would this option be given to the investor, and why would the investor exercise that option, exercise that choice of classifying an equity instrument as FEOCI instead of FETPL? Why would one do that? It is irrevocable. Yes. Impact on P&L. Yes. Once selected, FEOCI cannot be transferred. No, to make profit or loss in trading. Yeah. Okay. I think I got. So to avoid unnecessary fluctuation. Perfect. Sriraj, to avoid unnecessary fluctuations in exact wordings I was expecting. Exact wording. Yes. He has put the exact words. Okay. Sriraj has written the exact words I was expecting. To avoid unnecessary fluctuations in P&L. Perfect answer. That's what I was expecting. Okay. So obviously to avoid unnecessary fluctuations. Okay. So now look at it this way. Try to think a little bit logically. If you see, if you are holding this investment in equity shares, the objective was to avoid unnecessary fluctuations in P&L. You have transferred this to OCI. Yes, the standard allows you to transfer this to OCI or show this in OCI. But if the standard says that the minute you liquidate, it has to come to P&L, is the objective achieved? Is the objective of not having fluctuations in P&L, is the objective achieved? The objective is not achieved, right? You understand my point? If you say so long as you hold the investment, it will help you to avoid fluctuations in P&L. But when you liquidate, then it is going to affect your P&L in one bulk. The very objective of not showing the fluctuations P&L is defeated. So that is the reason why the standard says you don't transfer it back to P&L. There's no need to transfer it back to P&L. It can remain in OCI, which means it goes to add the reserves of the company. So of course, this profit belongs to the shareholders. It is belonging to the shareholders. It is part of your retained earnings. It is part of your retained earnings, right? So that means you don't have to transfer this to P&L when you liquidate. That is the reason why it remains in OCI. Okay. The same is not the answer for the other one, for the debt security. For the debt security, the answer is not the same. The debt security, the answer is, if it is, why it is classified as FVOCI? It is classified as FVOCI because you have the intention, you have classified this as FVOCI because it passes the SPPI test, obviously. The second one is the business model objective is to collect contractual cash flows and also to sell once. It entitles you to sell once, right? So that means whenever you sell, you may sell today, you may sell tomorrow, you may sell anytime. So that means the shareholders of the company or the stakeholders of the company would like to know what will happen if you sell it tomorrow. You may not sell, but if you sell it tomorrow, what will happen? So that is the reason why it has to be shown at the fair value in the balance sheet. So from the balance sheet point of view, it should be shown at fair value because you have the right, you have the choice, you have the right to sell at any time. That is the reason why you have classified this as FVOCI. But only once. You can't keep buying and selling, but you can sell once. And if ever you sell, that event is already crystallized. So whenever you have liquidated it, the event has crystallized. So that means it has to come to the P&L. So you were keeping it in OCI, you were nevertheless treating it as part of the net worth of the company, so long as you are holding it, that so long as you are not, you have not sold it, so long as you are holding it, it is part of your the net worth. So that is why it is shown as OCI. But when you have liquidated it, the event has crystallized. What event? The event that they can sell it once and only once. That is crystallized, already crystallized. When it is crystallized, obviously it becomes part of your P&L. That is the reason why it has to be transferred to P&L. Whereas in the case of equity, it should not be transferred to P&L. Because for debt security, the classification as FVOCI is not as a matter of choice, but it is arising on account of applying a set of objective criteria as defined as mentioned in the standard. You classified it as FVOCI not because of your own volition, but because of applying a set of criteria which are objective criteria. I hope it is clear. Now, if this is clear, then it means that you have understood understood the classification fully. Okay, now let me get on to financial liabilities. Now, financial liabilities is very, very simple. I'm telling you, financial asset was such a great complication, right? You had three types. You had so much of criteria. You had so much of objective criteria, SPPI test, business model objective test. Okay, blah blah blah. So many conditions with that. But financial liabilities, they made it very, very simple. Okay, so what is it? Financial liabilities will always be measured, will always be classified as amortized cost. As simple as that. Okay, so that means this is over. It is not over. There are a lot of things in financial liabilities which we are going to explain. Now, if it is held for trading purposes, if it is including derivatives, if it is FVTPL, if it is designated at FVTPL on initial recognition, then also the classification, then also it will be measured and classified. It will be measured at fair value. Okay, it will be measured at fair value. Now, all other financial liabilities, amortized cost. So it becomes very, very simple. Okay. But now let us look at it a little bit more carefully. Now the this one, okay. Now the second one here, designated as at FETPL on initial recognition. That means normally it should have been classified as amortized cost. So let us assume you have a debt exposure to the extent of 100 crores. So your debt exposure is 100 crores. This 100 crores, you should have classified this as amortized cost. You should be classifying it as amortized cost. Okay, there is no doubts about, no questions about it. But the standard says you can designate this at FET as FETPL also. That means you can measure this 100 crores exposure at fair value and take the difference of this fair value changes to the profit and loss account. That choice is given to you. That is what it says. The one which is designated as a FETPL on initial recognition. So these are not the ones that should be classified as FETPL. Please understand the difference between these two. Okay. There are certain things which should be classified as FETPL. What are those? Those are the derivatives. Derivatives should be classified as FETPL. Okay. But all other financial liabilities should be classified as amortized cost only. But you have the choice to designate certain financial liabilities as FETPL upon initial recognition. So initially itself, you can say, I want to recognize this at FETPL. So that means it is called as fair value option. FVO, it is called FVO. Please don't confuse this with the FVOCI. Okay, FVOCI is there only for financial assets. FVO is there only for financial liabilities. So FVO means fair value option. So you're exercising the fair value option. Now, this fair value option is not something that will be granted to you. It is not a boon that is given. So don't think, okay, I want to exercise this. No, it is not allowed. It is allowed only under certain conditions. What are the conditions? Now, reduce measurement or recognition inconsistency. This is known as what is called as an accounting mismatch. Okay. Now, this is the most important aspect of this. What is meant by an accounting mismatch? Okay, that is the first one. And then managing a group of financial assets or financial liabilities on a fair value basis. That is okay. That's a common thing. Now, let us understand what is meant by an accounting mismatch. Now, this accounting mismatch, I have some questions here. Let me see. Hedge accounting, will derivative MTM liability still be classified as FETPL? Okay, liability designated FETPL, give an example. Liability designated as FETPL, give an example. That's what I'm going to give now. Okay, Soundarajan, that's what I'm going to give now. If the company follows hedge accounting, will derivative MTM liability still be classified as FETPL? We will, I won't take that question now. Okay, because it's a random question. I have to explain. First, I have to explain what is hedge accounting. Only then we will be able to see that. Okay, and I don't think time will permit us to do hedge accounting today. That may not be possible. Okay, because I just don't want to do just to have a checklist of things and then tick everything done. I have completed. No, but whatever we cover, let us do it in depth so you understand this concept clearly. Okay. Now, what is meant by accounting mismatch? Now, let us take one example. Okay. Now, I'm going to requires a little bit of explanation. Okay. Now, are you able to see my screen? My Excel, are you able to see?
Yes, sir.
Okay. Now there is, okay, wait a minute. Okay. Now, there is a debt exposure. Okay, debt security. This is a debt exposure. You have a liability of say 100 crores. Okay, I think we are comfortable with crores. So we'll call this. Should we call this 100 crores? I think I'll be better off calling this 100 crores. Sorry. Okay, 100 crores. Okay. Now there is a debt for 100 crores. There is a debt for 100 crores. This debt is a fixed rate exposure. Okay. You have to pay interest at the rate of 8%. How did you arrive at this 8%? The risk-free rate is 6%. The credit spread for this rating, which I believe is AA, okay, is 200 basis points, 200 bips for this entity, which is rated as AA. So the total rate becomes, interest rate becomes 8%. So you have issued, as a company, you have issued a debt security at a fixed rate of 8%. And this has the interest rate exposure at the rate of 8%. And your interest expense for the next 5 years is going to be 8 crores every year. Is it clear? Now, the chief risk officer, sorry, the corporate economist, saw this one and said, why on earth did you take a fixed rate exposure when the interest rate is going to come down? The interest rate is going to come down all over the world, and in India also there's no exception. It's going to come down. So there is no point in having a fixed rate exposure. You convert this into a floating rate exposure. So you take an interest rate swap, converts this 8% fixed rate to a floating rate. So that means you receive 8% and you pay floating rate. On the date on which you take this, obviously the interest rate would be 6% and the credit spread is 2%. So you will also pay 8% on the date on which you take, because on the date on which the interest rate swap is taken, the fair value will be 0. So how can the fair value be 0? It is because the rate what you receive and the rate what you are expected to pay is going to be the same. I hope you all understand what is meant by an interest rate swap. Okay, I'm just taking that for granted. If you don't know, let me know. I can give a 1-minute explanation of this interest rate swap. Is it required? Should I? Do you want me to explain what is meant by an interest rate swap? 2 more. Okay. Many people are saying yes. Okay, I won't take much time. I will explain in about 2 to 3 minutes time. Now this interest rate swap, as the name suggests, you have what is called as a notional amount. So the notional amount is not exchanged. What is exchanged is only the interest. Interest is what is swapped. That is why it is called an interest rate swap. So you swap a fixed rate with a floating rate. Or vice versa, a floating rate with a fixed rate, right? So that is what you swap. So normally one is fixed, one leg is fixed, the other leg is floating. So the floating leg is based on some benchmark. It could be, somebody has raised the hand. Who is that? Okay. So you.
Sir, I made them as a post. If they are like having any doubts, they can mute themselves and they can ask the questions. Like lower the.
Sorry, what is that?
Proceed with the question. We can proceed with the session.
Okay.
Participant, 1 second, sir. I'll give the information. Participant, if you have any doubts, please don't raise your hand. Please raise your questions in chat box. Thank you.
Okay. Yeah. So this interest rate swap, usually one leg is float, the other leg is fixed. Okay. So one is a pay leg, the other is a receive leg. So one is fixed. Now, in this case, this is fixed. That means you are already paying 8% on your debt security, which you want to swap with a floating rate because you think that the interest rate is going to go down from 6% today. The risk-free rate is 6%. You expect the 6 rate to go down to say 4% and then to 3% and then to 2%, etc. Like that, you are expecting it to go down. So as a result of which you have taken this instrument. So this converts the the fixed rate exposure to a floating rate exposure. That is the purpose of this interest rate swap. So what is exchanged is not the notional, but the notional is the amount on which the interest is computed. But this notional itself is not exchanged because there is no point in first giving 100 rupees, taking back 100 crores, right? Giving 100 crores, taking back 100 crores. So it is not exchanged. So that is the purpose of this interest rate swap. But this interest rate swap is in the nature of a derivative. And all the derivatives, as we saw, will have to be recorded or classified as FETPL, which means the fair value changes of the interest rate swap should be recorded in the P&L. So now there are two consequences that happen on account of this interest rate swap. Please understand what are the two consequences. The first consequence is that, which is the intended consequence. I call this as an intended consequence. What is the intended consequence? You wanted to reduce, that's what you believe, okay? That is why you have taken this. You wanted to reduce your interest expense. You are paying 8%. You wanted it to reduce because you thought this floating rate is going to come down. So you wanted to reduce your expense. So that is first thing. The second one, unintended consequence of this is that there is a fair value that happens at every time, every valuation date. There is the fair value of the interest rate swap, which has to be recorded in the balance sheet, and the difference or the fair value changes in the interest rate swap will have to be recorded in the profit and loss account. So the profit and loss account will also undergo some changes on account of the fair value changes of the interest rate swap. So there are two consequences that are happening on account of taking this interest rate swap. One is the intended consequence. The intended consequence is that your interest rate as an expense, your interest expense aligns with the floating rate. Of course, if the floating rate goes down, you stand to benefit. That was what you thought would happen. The unintended consequence is that the interest rate swap will have to be valued on a fair value basis, and the difference between the fair value will have to be shown in the profit and loss account. So that is the unintended. So now here you see this column. So the fair value, the swap column, you see. Now the fair value, it has a fair value. Now this fair value is actually shown in the profit and loss account. So the profit and loss account, it gets affected by this. Okay. So that means because of having the interest rate swap, your profit and loss account gets unnecessary changes. Why? As far as the, now let us come to this one. Okay. Yeah, sorry. Okay. Now the accounting mismatch. Now there is a debt security. Now I have taken the essence from that screen and I have put it here in the way which we can understand. So there are two instruments here. One is the debt security. This is your fixed rate exposure. Okay. And the other one is the interest rate swap. Now I am not looking at the interest cost because interest cost would get itself aligned to the floating rate, right? So instead of 8 crores, it will become 7 crores if the interest rate falls down to 7%. You understand that? I hope you understand that portion. So what I am showing here is only the fair value changes. I am only now talking about the fair value changes, which I described it as unintended consequence of having an interest rate swap. The unintended consequence is that here the debt security, the classification of debt security is what? Is amortized cost. So the fair value changes becomes zero. There is, you don't recognize any fair value changes of the amortized cost instrument. It will continue to be shown. The carrying value of 100 crores will be 100 crores on day one and every year after year. Whereas the fair value of the interest rate swap is shown here. So this will be your fair value changes that is shown in the P&L. So in other words, your P&L will get affected by this much. So overall, eventually it will become all years put together, the fair value changes or the P&L impact will be zero. But on a year-on-year basis, the P&L will undergo fluctuations. Is this clear to you? If it is not clear, then I will explain this once again, because this is the most important aspect. If you have understood this, I can tell you you have already understood 50% of hedge accounting. It may sound a tall claim, but that is a fact. You have understood 50% of fair value hedge accounting. 50% of fair value hedge accounting is completed. You have understood this concept. Okay. So now, what are we trying to do? We had one debt security. We bought another instrument. The objective of this instrument was to convert a fixed rate exposure to a floating rate exposure. But unfortunately, the unintended consequence of this is there is an unnecessary fluctuations in the P&L, not on account of the fair value changes of the interest rate swap. Is this point clear to you? Is this concept clear to you? Anybody wants it to be explained once again, or is it clear? We have how many minutes more? Oh, we have only 15 minutes more. Okay, now the how to avoid this? Now in order to avoid this, what you can do, you can also value this debt security not at amortized cost but at fair value. So now that's what we are doing here. Now here in this case, the fair value option solution. So here the fair value of the debt security also fluctuates. So the fair value changes of this is taken to the P&L. The fair value changes of the interest rate swap is taken to the P&L. Net, if you add, the fair value changes on account of both these instruments become zero. So that means there was an accounting mismatch here. This is what is an accounting mismatch. The accounting mismatch caused a profit and loss fluctuations. In order to avoid the accounting mismatch, you are exercising an option which is called as FVO option. You are exercising this fair value option, and because of exercising this fair value option, you have effectively avoided fluctuations in the P&L. That is the whole objective of this fair value option. So now the standard says, as far as a financial liability is concerned, the financial liability will always be measured at amortized cost unless there is an accounting mismatch. If there is an accounting mismatch, when will there be an accounting mismatch? When you have two instruments. The basis of these two instruments are different. One instrument is measured at the amortized cost. Another instrument is measured at the fair value. So if there is an accounting mismatch, these two instruments are supposed to go together because one instrument was purchased with the intention of converting a fixed rate to a floating rate or vice versa, whatever it may be. So intention was only to convert this. It was not on its own volition. It was only to convert a fixed rate to a floating rate. So there is an accounting mismatch. So in order to avoid the accounting mismatch, the standard says, okay, no problem. You are allowed to value the debt security on a fair value basis. So the problem is solved. Is it clear how the problem gets solved because of allowing the entity to do the fair value? Now you thought that the problem is over, but unfortunately the problem is not over. I will tell you why. Okay. Now what will happen? The Treasury Department, who are in charge of this interest rate swap, they may sometimes sell this off. So the Treasury Department liquidates or winds up, it is called, terminated. The interest rate swap contract may be terminated. If it gets terminated, the option to value the debt security or to record the debt security at fair value will continue to be there, because it is an irrevocable option. That is the danger there. It is an irrevocable option. So there will be some fair value changes coming from the fluctuations in the debt security, but there will not be any change coming from fair value changes coming from the interest rate swap, because it is not there. It has been sold. So you will still have fluctuations in P&L. So you find that this solution becomes a problem, or this is the typical case where the remedy is worse than the disease. So you thought this was a remedy, but unfortunately, this remedy is worse than the disease itself. Is it clear? Lot of concepts. So, okay. Okay. Now, now let us get back to this one. Okay. Let us get back to the PowerPoint. Okay. So the point is, if there is an accounting mismatch, then you are entitled. Now, see, unfortunately, what happens is that this accounting mismatch, the entity is allowed to record fair value, record the financial liabilities at fair value. But sometimes this can also be misused by the entity. Like, for example, unless I tell how it can be misused, you will never be able to understand the reason why the accounting has a different angle. Okay, I have to tell you, fair value option exploited. Now what happens? The interest rate swap is liquidated. Okay, now there is only a debt security available, and the credit spread, the credit risk, the entity's credit risk becomes more and more. The entity now becomes more and more riskier. So as a result of which the credit spread goes up. When the credit risk goes up, the fair value of the instrument becomes less, because when the interest rate goes up, the fair value comes down. Interest rate goes up, fair value comes down, right? So the fair value of the debt comes down. Fair value of the debt, if it comes down, the carrying value comes down, the changes will be reflected in the P&L as a profit, right? So that means the more, the riskier the company becomes, the more profit it makes. You understand? So the company becomes more and more risky, but the company starts making more and more profit. Is it not counterintuitive? So is there something, there is something wrong here, right? You understand the point? There is something wrong, because the company becomes more risky. The fair value or the carrying value of your liability goes down and down, and you make more and more profit. Is it right, or am I talking nonsense? Am I talking sense, or is it wrong? Is there anything wrong here? So what I'm saying is correct, no? There's nothing wrong. So you can afford to become more and more risky, and you make more and more profit. So the CFO stopped coming to the office. The company became more and more risky. The CFO also invited the CEO. Both of them stopped coming to the office, and the company became more and more risky, and the company started making more and more profit. Something is not right, no? Or everything is right? So risk is directly proportionate to profit. Come on, there is no, this risk is, the profit is, okay, something is wrong. So somebody is saying something is wrong. Amit is saying something is wrong. Okay, now there's nothing wrong. Conceptually, everything is correct. Okay, but so this was the lacuna, or this was the loophole. Now this loophole was plugged by the accounting standard. as immediately after the financial crisis, sometime during 2012, 2013, this was amended. And then they said that the changes in the fair value on account of changes in the benchmark rate alone will be taken to the P&L. If it is on account of changes in the credit spread, or this is called as the own credit risk, changes on account of the own credit risk will be recognized in the other comprehensive income, which will remain in OCI, which will never be plowed back to the P&L. So here in this case, all these profits will not be recognized in P&L, but it will go to the OCI. So what is the effect? What is the impact of this? The impact of this is that the company, the EPS of this company cannot be increased on account of this gimmicks. The company will not show higher EPS. So in other words, the company, it can only be shown in the other comprehensive income. So that is a lacuna, and that is how this lacuna was plugged. Okay, that is what I want to tell. Now let us get back to this one. So here you have this own credit risk. Fluctuations on account of the own credit risk is what is recognized in the OCI. Fluctuations on account of the asset specific risk is considered in the P&L. So in this case, only everything will be considered in OCI and not in P&L. Okay, so that is what. Okay, I have given some examples. I will share this with you. So I have given some examples as to how this was this profit and loss account used to be recognized earlier, and how it got changed. Okay, all those things I have given here. You can probably go through this. You know what happened during 2008, how it was exploited. Okay. So instances where OCI should not be reclassified. So one of the instances which should not be reclassified is gains or losses due to changes in own credit risk. It is which is designated at fair value, the FVO option. It cannot be reclassified to P&L. It will remain in OCI only. Okay, that's what I want to tell you. Okay, now we have only 7 minutes. Okay, I thought I will actually dwell a lot on ECL, because this is my favorite topic. Somehow I don't know, we have 7 minutes now, so I will pass for a minute or so, but can you ask some questions? Do you have any questions on so far whatever we have done?
So, yeah, can we unmute some participants? Whoever wants to ask a question, please raise your hand so that you can be unmuted. Anyone wants to ask the questions, please raise your hands.
Okay, if there are no questions, I will give a 5 minute, because whatever minutes we are left, I think we are left with just 5 minutes. I will try to give at least an overview of ECL. Okay, is that okay? I don't want to leave this. It's a pretty vast subject. I wanted to actually show you some practical examples and all, but okay, now the key point in the expected credit clause is that this was the one that was introduced by the third amendment to the standard in July 2014, where this is mainly based on some forward-looking information. Okay, so forward-looking information also plays a vital role. That is one of the things. The second one is that it is now talks about the expected credit clause more or less on the same lines as what you have in Basel. Okay, in Basel you have the LGD into PD into LGD into EAD, exposure default, multiplied by the time value of the money. All those things will give you the expected credit clause. Now the IFRS 9 or Ind AS 109 does not talk about this method or this equation called as PD into LGD, nowhere it is mentioned. Okay, but it is all mentioned in a highly theoretical way. It is given in a highly principle based way. Now the whole ECL concept here is now based on is highly principle based. Okay, it is principle based. So which is good and bad. I'll tell you, it is good and bad, because it is good because you can always follow the spirit of what is given there. Okay.
Sir, just 1 minute, Venkat sir. There have been many requests whether you can extend the session. How long would this thing take?
You give me another half an hour, I will do justice to ECL.
I think that there have been many requests for you to extend the session. If it's not a problem with you, I think we can extend the session. I'm glad to do this for another half an hour. Yes, sir. You can do it in depth because many people want it to be done.
That will be wonderful. Thanks a lot. Really, I appreciate that, because okay. Now, see, now the ECL as per IFRS 9 is completely different from ECL as per US GAAP. The reason why I'm saying that is because as per US GAAP, it is completely rule based. Okay, it gives you a list of methods which you can follow. There are about 6 methods that are prescribed there in US GAAP. IFRS 9 does not talk about any particular method or model. Method itself is not there, no question of specifying any model, but it nevertheless it gives wonderfully the principle that are to be adhered to. So it's a wonderful piece of literature which gives you how the expected credit loss has to be computed. Now the first thing is that now this is based on it is not based on incurred loss model. Okay, to some extent we still follow the incurred loss model for the purpose of calculating ECL on trade receivables. We follow what is called as a simplified approach. In that simplified approach is heavily dependent on the incurred loss, which is also called as the historical loss. Okay, but not so from the perspective of the ECL for loans. So okay, let me give an overview. ECL, there are 2 types. One is ECL for loan portfolio. The other one is ECL for the receivables portfolio. ECL for loan portfolio valuation is different from the ECL for receivables. For receivables, it is heavily dependent on the historical loss. Not so in the case of ECL for loan portfolio. ECL for loan portfolio is based on first the determination of the probability of default. So there are a number of ways by which you can define, you can find out the probability of default. Okay. Then the second one is what is the loss given default. Now the loss given default again depends upon what is the collateral that is available, what is the haircut that you should consider on the collateral, and again, what is the time that would take for you to realize the collateral. So these are the 3 key elements that will tell you how much of the money is recoverable from the collateral. So which basically enables you to compute what is called as the recovery rate. 1 minus recovery rate will be the loss given default. So that is also defined there. Then the third one is what is called as an exposure at default. So at the time of default, what would be your exposure? Now this exposure at default has to be computed at every stage, because you will be probably having some write-off at every point of time. There will be some prepayment, there will be some periodical payments that happen, there will be some prepayments that can also happen. So all these put together will have to be knocked off, and what remains is what is called as the survival principle. You have to find out what is the survival principle at every stage and apply the PD and LGD for every cash flow, and then find out what is your historical loss. Now this is the overall approach. Okay, now once you do this, then this has got to be calibrated with what is called as a forward looking macroeconomic data. Now, there are a number of macroeconomic data that are available, especially if you go to Bloomberg or if you go to Economist, you will find as many as 300 macroeconomic variables. These variables are called as what is called as an independent variables. These are independent variables. The dependent variable is your actual exposure, that is your actual receivable. Your receivable is your dependent variable. These independent variables are GDP growth, it could be inflation, or it could be the risk-free rate, or it could be the oil price, or it could be anything. There are about 300 such variables. So not all variables or the independent variables would have an impact on the dependent variable. The dependent variable here is your receivable portfolio. That is, it could be loan portfolio or it could be a trade receivable portfolio. Now, first thing you have to find out what is the relevance of this. So unless it passes what is called as a statistical test, you have to run a multivariate regression analysis to find out whether there is a significant correlation between the independent variable and the dependent variable. Only those things, like for example, your R squared test should be greater than 60% ideally. Your p-value should be less than 0.05 and so on. There are a number of such factors, statistical factors that have to be considered. If you consider all that, you pick and choose only those variables which are relevant, and based on that you construct what is called as macro. You consider what is called as the scenarios. Now the standard wants you to have at least 3 scenarios. One is the base scenario, the other one is 2 additional scenarios would be required, and you have to compute what is called as the probability weighted expected credit loss. Now, this is significantly different from what is mentioned in the US GAAP. The US GAAP tells you what is the most likely outcome. Here, we don't consider what is the most likely outcome. We assign probability for each scenario or for each outcome, and then compute the probability weighted expected credit loss. That is how this is computed here in this case. Okay. Now this is at a macro level. I have given you a 30,000 feet overview about this one. We will get into some details now. Okay. We have time. We'll cover that in full. Now, what is in scope? All financial assets are in scope. Out of scope, equity investments and some instruments which are valued at FVTPL. Okay. Now I will get into the meat. I will get into the what. Right. Okay. Now the general approach is the expected credit loss. The way it is defined is the present value of all cash shortfalls over the expected life of the instrument. So the present value of cash shortfalls. The definition does not talk anything about probability of default, loss given default, exposure to default, the time value of default. None of those things are explicitly given. It is not a Basel formula, LGD into PD, nothing like that. Here it talks simple, plain English. It is left to the interpretation of each and individual, and the interpretation should be properly articulated in your report. You have to articulate in a report how you have interpreted those things, right? So the expected credit loss in simple terms, this is the present value of all cash shortfalls. Present value of all cash shortfalls. So cash shortfalls means it is the difference between your contractual cash flow and the expected cash flow. So if there is a probability of default, if there is a default that happens, your expected cash flows will be lesser than your contractual cash flows. So you find out the difference between the contractual cash flows and expected cash flows, and the difference between these two is known as the actual cash shortfall. And you find out the present value of the cash shortfalls, which means that you have to discount it back to the current date, to the date, applying the discount factor based on the EIR of that instrument. So every instrument, as I told you at the beginning, has an EIR which is never ever changed. So the EIR continues to remain the same till the end of the life of the asset. So based on that EIR, you find out what is the present value of the cash shortfalls, and that becomes the expected credit loss. Now, when you apply the probability of default, the probability of default has to be computed separately for 12-month, or it can be for the lifetime. Now, for all assets, it has to be computed for, I'll go to the next slide. This is what I explained. Cash shortfall is the difference between the cash flows due in accordance with the contract and the cash flows the entity expects to receive. Now, the impairment or the ECL is measured either based on the 12-month ECL or lifetime. Normally, it is 12-month. 12-month is because the portion of the lifetime expected credit loss that represents the ECL from the default event occurring over the next 12 months. So, in other words, the probability of default is restricted to 12 months, whereas the entire cash shortfalls is computed for the entire life of the asset. So don't mistake if you say 12-month ECL doesn't mean that you are going to calculate the cash flows occurring over the next 12 months. No, the cash flows, the cash shortfalls for the entire life of the asset will always be considered. But what is considered in the 12-month ECL is the probability of default occurring only over the next 12 months is considered here. Okay, so that is the one which is for the one for all the assets. By generally it is for all the assets. This is how it starts. But then when the credit risk increases significantly, now this credit risk increases significantly from the initial inception. From the initial inception means what we are now talking about is a relative fall in the quality of the financial asset. There is a relative fall. Like for example, I will give an example. Now you have bought a financial asset. The financial asset has a rating of, say, it has a rating of C. Okay. Another financial asset has a rating of A. Okay. Then at the end of 3 months, at the end of the first quarter, the one which was bought at C rating continues to remain at C. The other instrument which was bought with a rating of A now becomes C. So when you value at the end of the first quarter, both these instruments have a rating of C. But the second instrument, which was originally rated at A, has now fallen 2 notches below the A rating. So the asset has experienced a significant reduction in the credit risk. So the asset has increased, the significant risk has increased significantly. So SICR has happened, significant increase in credit risk has happened for this one, relatively from the time you bought it. So the second instrument will have to undergo a lifetime impairment. So you have to find out what is the probability of default for the lifetime as far as the second instrument is concerned. So when the credit risk on the financial instrument has increased significantly since the initial recognition, which means there is a relative deterioration. There is a relative deterioration, then it means that SICR has happened or a significant increase in credit risk has happened. If this has happened, so when do you say it has happened? There is no definition. There is no definition in the standard, but you have to only see whether the risk has increased significantly since initial recognition. But there is a rebuttable presumption in the standard which says that if the DPD or the days past due are more than 30 days, then it becomes SICR has happened. If SICR has happened, then you have to consider lifetime default. Now, the second one is the definition of default. There is no definition of the term default. So each entity should define what is default. But there is, it should be consistent with what is used for the internal risk management purposes. You should also consider qualitative indicators. And there is a rebuttable presumption that if the DPD is greater than 90 days, then the default has occurred. It is very similar to that of the NPA rules, which says that 90 days, above 90 days, it becomes NPA. It is the same as a default here. Okay, these are some examples. Some examples that are given. Okay, I just want to cover some. Okay, the overview. We have seen the overview. Stage 1, where there is no increase in significant risk, and also it has a low credit risk at the reporting date, then you have to consider only 12-month expected credit loss. Now, the key feature is that the interest revenue is calculated on the entire carrying value of the asset before considering the credit loss allowance. When the SICR has happened, when the credit risk increases significantly, then you have to consider the same way interest is calculated, okay, on the gross carrying amount, but the probability of default will be applied for the entire life of the asset. Then when it actually defaults, then you should provide for the entire amount. Now okay, now for when it moves to the third stage, the interest revenue is calculated on the amortized cost, which means the gross carrying value as reduced by the loss allowance. So the interest income will be calculated on the net amount, not on the gross amount. So that is the key feature, and usually the PD will be taken as 1, okay, because the probability for default has already occurred, so the PD will be taken as 1. Okay, now shared credit risk. Okay, this is one which I want to tell you is the probability weighted outcome. Now the standard wants at least 3 scenarios to be computed. Okay, now the 3 scenarios, now the term expected, okay, the term expected credit loss, expected value, expected cash flow. Okay, expected is a technical term that refers to the probability weighted mean and should not be confused with the most likely outcome or an entity's best estimate of the ultimate outcome. Now, this is the key differentiating factor between the ECL as per US GAAP and ECL as per IFRS. So here we need to compute the probability weighted. Now, I have an example here. Now, let us assume these are the various scenarios, or you can call this as outcome. For our purpose, you call this as outcomes. Okay. So there are 5 possible scenarios, and each one of the scenario is assigned a probability of say 10%, 15%, 40%, etc. And this is the ECL that is computed for each one of this. So the most likely outcome is 40% because that is the maximum, and it has an ECL of 2000. So as per US GAAP, you would probably arrive at 2000. Okay, but as per IFRS, you will assign the weight. So you have to compute what is the probability weighted, and you arrive at 2362 as the ECL position. Okay, again, US GAAP, there are certain other conditions like, the entity should have opted for this, etc. Additional conditions do apply for US GAAP, but just for the sake of comparison, for the sake of understanding, I'm telling that. Now here we are not going to consider the most likely outcome, but what we are going to consider is the probability weighted outcome. Okay. Now the macroeconomic factors, macroeconomic indicators should be considered. Now I told you that the macroeconomic indicators, you have to use the information that is available without undue cost. So it doesn't mean that you pay a fortune to either whoever is the service provider and then get this one. It is not needed. So there are a lot of open sources, reliable open sources, the same thing which are available. So you can use those things. So you have to do it without undue cost. So some of the factors that I have found relevant are, inflation, unemployment rates, interest rates, then GDP growth, like that. There are some things which can be used. Now, how to build scenarios? I have made a small write-up on how to build the scenarios, because many people ask me, is it judgmental based, or is there a scientific way to build the scenarios? So there are scientific ways by which you can build the scenarios using macroeconomic data. Now, the first step is, you get the loan receivable snapshot for the last several periods. And this is called as the dependent variable. So the loan variables, the loan receivables for the various periods. Now let us assume, you get quarterly data for the last, say 5 years. So that means 5 into 4, 20 period data will be there. Then you also get the relevant macroeconomic data. So let us assume you get GDP, inflation, risk-free rate, all those stuff for the same periods. Then you run a multivariate regression analysis between the dependent and the independent variables. And based on this, what you get is, you have to find out if the statistical test passes, that is R squared, p-value, etc., should all be within the norms. And if it is within the norms, then it means it passes. If it doesn't pass, then what happens? You have to iterate the regression analysis with the combinations of independent variables. Like, for example, first you take 3 variables: GDP, inflation, risk rate, let us assume. Okay. So all the 3 put together, the test doesn't pass. If the test doesn't pass, then you take only 2 variables at a time: GDP, inflation, and the inflation, risk-free rate. Then GDP, inflation. Like that, you take two variables at a time and then see whether it passes. So keep on iterating like that till it passes. And when it passes, you find out the intercept and the slope. And using the intercept and the slope and the formula y is equal to mx plus c, you find out what should be the projected value of the loan receivable for the future date. So this is how you arrive at the future number. Now when you do this, you get the values by which you will have to bump up or bump down the ECL based on this one. Again, do the same thing for a different set of parameters. The projected values, macroeconomic values, you find out for the additional scenario. So that is how you arrive at these 2 scenarios. So now just some example I have taken. Okay, the macroeconomic indicators. So the macroeconomic indicators I have taken are for this data point date, GDP, inflation, and risk-free rate. You can take like this, and you can also take the snapshot of the various valuation dates. Okay, you can take those for the same dates, and then run the multivariate regression analysis. So if you run this one, so when I run with all the 3 variables, the test doesn't pass. So I just ran this with only these two variables, which is inflation as well as the GDP growth rate. When I did that, the significance, the R squared, basically R squared passed. UF significance also passed. The p values also passed. So when all these things pass, I take the intercept and the slope. I take the intercept. This is the intercept and the slope. I take the intercept and the slope, and based on that, I arrive at the next interest at these 2 variables. Okay, the last, whatever you see in yellow, these are the 2 scenarios that are obtained based on the intercept and the slope. It is not an imaginary data, and based on this, you arrive at the resultant scenarios. So this is how we arrive at. So for arriving at this scenario, what I have used, I have not used the risk rate because it did not pass the test. Inflation and GDP growth rate were used, and this resulted in an increase or decrease. Actually, this results in a decrease of default to the extent of 14.38% for scenario 2 and 23.67% for scenario 3, something like that. So you will have to apply these to build these 2 scenarios, and then apply the probability weight. That is judgmental. The probability weight is judgmental. So the probability weight, normally what is done is that you use the maximum weight for the current scenario, which is the base scenario. So obviously, you use 40% for the base scenario and use 30% each for scenario 2 and 3. And based on that, you arrive at the probability weighted ECL. Okay, so that is how it is computed. And maybe we will go through one simplified approach for receivables. Okay, now why I have taken this separately is because this method is slightly different. The simplified approach, as I said, is heavily dependent on the historical loss, credit loss. Okay, this is dependent on that. So the accounting policy choice for receivables, there is no choice. You have to use the simplified approach only. Okay, that's what it says. So the first step is first determine the grouping, have a proper grouping. So this is what is called as the segmentation. You have a proper segment. Okay, that segment is created based on any one of these, whichever is relevant. It could be geographical or product type or whatever, right? And aggregate the receivables into group that share similar creditors. That is the first step. The second step is determine the period over which the historical loss rates are appropriate. So now this, what does it mean? It means that you select the sample period. This is what is called as the sample period. Now the sample period should be representative. So it can't be too small, too less, or it can't be too wide. It has got to be appropriate. So normally you know about it should not be too small or too big. So normally 2 to 5 years is considered to be more relevant. Now the auditor may insist you can't stop with 5 years. You may want to have for the last 6 years and so on. So it depends upon the auditor's prerogative in order to determine the sample period. So for this sample period, determine the historical loss rates and find out the loss rates for each segment. Okay, and for each bucket. So classify this into different buckets. Usually 30-day buckets are most convenient. You do it based on the buckets. And the step 4, you consider the forward-looking macroeconomic factors. As I explained to you, based on this, you find out which factors are relevant and find out the bump up or bump down percentage. Now, in the previous case, as I showed you, we got two scenarios. Okay, the two scenarios, both the scenarios resulted in a decrease in the default. One scenario it was 14%, the other scenario was 23%. So that means it does not mean when you have two scenarios. I have seen many people wrongly interpreting that the one scenario should be a pessimistic scenario, another scenario should be optimistic scenario. It is not like that. It should be it should be based on the it is not based, it is not dependent on the it doesn't mean that one should be pessimistic, another should be optimistic. It will result in whatever comes based on the multivariate regression analysis, as I explained to you. In this case, both the scenarios were positive scenarios or were favorable scenarios, because both showed decrease in the default. Okay, so it's very obvious, because after the pandemic now we are expecting the economy to reverse, to go up. So which means that we expect the default rates to come down, or in other words, both the scenarios point to a much rosy picture than it was in the previous period. That's what it means. So the very objective of this forward-looking information or the scenario building is to see what is the reality, how it's going to be in the near future. That is not based on anybody's guesswork. It is based on the past data in relation to the past macroeconomic data. We can arrive at easily how the future is going to be. The historical, now in this case, coming back to the simplified approach, the historical rates are the starting point. So arrive at the historical rates and find out the percentage. Once you find out the percentage, the final step is that apply the percentage to the actual receivables value to get the historical loss. Then you also have to compute this based on the probability weight scenarios. Okay, so this is how this. So some example, I have just shown you some example how this is actually computed. So trade receivables aging. Okay, this is for the base scenario. So these are the amount. These are the historical loss rates. Okay, and this is the loss rate which you will be applying to find out the actual ECL. So just some sample numbers I have shown you how it is actually computed. Okay, finally how the probability weighted is done. Now I think we have time for just okay. Any doubts? I think I'll take the doubts, because there are a lot of more things to cover. I don't think we have time.
I think there was one question, sir,
Ah.
upon this level 1, level 2, and level 3 inputs. It's asked by C.A. Raman. Sir, can you briefly touch upon level 1, level 2, and level 3 inputs?
Level 1, level 2, level 3, but that's coming under 113, no?
Yeah, it was asked some time back. I think you didn't touch upon it.
Okay, level 1 is obtained from the actual quoted rates. Level 2 is based on the not on the quoted rates but the observable inputs. Level 3 is derived, marked to model. Level 2 is marked to market. Level 3 is marked to model. Well, I think I missed out something in between. What is that? Somebody said mismatch. What is that? I don't understand. Oh, Ocha, you are talking about the mismatch of accounting mismatch. Okay. Okay, I think I missed out. Any questions that is left unanswered? Okay, which is coming under this purview. Can you just type out one or two? I don't know. Did I miss out something because there were quite a few.
So some of them were for extending the session.
Okay. Okay. Yeah. Yeah. See, 107. I mean, we have to cover even hedge accounting is there to cover. Okay, that's what is under 109. There's no. I mean, we just can't. It's normally a 3-day topic, and 107 is purely a disclosure standard, just a checklist. I think there is nothing much to elaborate there because there's no principles involved there. Just a checklist. Any specific question? Link of the recording, yeah. Okay, now there is nothing like provision for doubtful stuff. It is only an expected loss allowance, and this expected loss allowance is supposed to be nothing like having a provision different from what is this. There can't be any hidden reserves. That is the general thing for IFRS or for Ind AS, right? There can't be any hidden reserves. So you are supposed to create the loss allowance exactly for what you get. Nothing not 1 rupee more or 1 rupee less, right? So that is the spirit. Yes. If you still have questions, what I suggest is that you can write to me or to the institute and they will forward it to me. I can explain if if it is not generic, even if it is specific, you can send it to me. I will try to answer it as much as I can. Clear. I hope you were able to understand, at least do some justice for the topic that is given.
Yeah, I think everyone, you've answered everyone's questions, and participants, if you have any further doubts, I think you can share it with SIRC or even get in touch with say Venkat directly. I'm sure that he's done so many live case studies here and answered all the questions very patiently. We will be sharing the PPT at the end of today's session because sir will be sharing it with us, and we will be sending a mail. And also the link will also be shared for the YouTube, and also the link into the PPT which will be hosted on the site. So please do wait for some time. We will share it with you because there is a lot of queries about that. And I think if there are no further questions, we will close out the session. Okay, so I think there are no further questions.
Ma'am, Santosh has a try.
Yes, one Mr. Santosh has raised his hand. Can you unmute him? Yeah, see, Santosh, you can.
Hello, madam. The question, not to sir. Thank you, sir, for the good explanation on the standard. The question is to the madam that I could not get the Zoom link earlier. So if you can put in the WhatsApp group for tomorrow, it will be helpful.
Yeah, okay. Monica, can you just create a WhatsApp group? See, the WhatsApp group is...
We already have a group for Ind AS, ma'am. I will share the link of the group, ma'am.
Yeah. Probably you can add C.S. Santosh. You are not added in the group, sir?
No, I'm part of the group, but this morning I was just following up for the link as I could not get it.
Okay, fine. Okay. Monica, please share the daily link in the group.
Anyhow, we are sending the mass mails of the link, sir. We can't post it in the group. So if you're not received the link, kindly put a mail to SARCCP, sir.
Okay, you can just ping that in Zoom chat as that email ID.
Tomorrow's program, you will receive the link by 5 p.m. So by today, 5 p.m.
Okay, thank you. Okay. Thank you, sir, again.
Okay. Yeah, so whomsoever you're not a part of the group, probably you can get in touch with Monica. She will add you to the group. So if we don't have any further questions, I agree that, the subject is very vast and sir is taking the session so patiently and answering all the questions. We are running short of time. Hopefully we will be able to have a more extended session next time. Anyway, thank you for your generosity in extending, as per the participants' request, sir, and sharing the knowledge. I think this was really, as Mr. Venkatesh is telling, an awesome session, a wonderful session. Those are the feedback which we are getting. A really very, very comprehensively explained session. So thanks a lot for sharing your knowledge with us so patiently and answering all the questions. Thank you very much once again. The WhatsApp group link is shared here. The Excel sheets will also be shared once Sir shares us the PPT and the Excel sheet. So we will see you all again tomorrow for the next session on Ind AS 115. So till then, thanks a lot, everyone. Thank you very much, Venkat sir. Such a wonderful session.